A very good morning to each and every one of us who have joined us. And thank you so much for joining us for today's webinar entitled Unmasking Global Uncertainty, Inflation and Interest Rate Shifts. My name is Fiona Lucalo, and I'm very privileged to be your moderator for today's session. Just to give you a brief background, global economy has been undergoing changes and a lot of uncertainty. And all these will eventually affect how we save, how we invest, and how we plan for our future. So we would love this to be an interactive session. Please feel free to post your comments, post your questions on the chat box, and we'll be able to respond to all of them during the session. So without much further ado, allow me to introduce you to our first speaker for the day, Mr. Mwenda Rarama. Mwenda has over 18 years of experience in capital markets and is currently serving as our Chief Investment Officer here at Absa Asset Management Limited. Mwenda, over to you.
Thank you very much, Fiona. Allow me to just share the presentation. To our heroes, welcome to this wonderful session that we're having today. And we want to delve into what actually is used for valuation purposes, which should be interest rates. Interest rates are discussed a lot, but there's a bedrock and a guidance as to how this works as well. A lot of it is basically informed by the inflation levels. It's also informed by the global uncertainty and the issues that we have across the globe, and some of the items that are actually moving quite a bit across board. So in that, we look at the interplay of what the uncertainty means, what impact it has on inflation, what impact it has on interest rates. We look back at what has been happening and basically give you our thoughts going forward and the way forward, and help you basically to put together investment strategies that you can actually build a good way of being able to walk through these very volatile markets. We'll then move on to look at the solutions that we have to offer in terms of products that can actually fit into your strategies and help you to basically go through the uncertainties and be able to make some money out of all this. Finally, we'll look at the challenges and the myths that are basically out there, just trying to demystify some of them across board. So to kick us off, I'll start off with the global scene. So what has happened in the globe over the last couple of years is largely informed by some of the items some of the issues that have been going on. We look back and see what has happened and basically what impact they have had. The interesting thing, if you look at we've just tracked the US market, and when you look at the US market in particular, which is basically on your left, shown by the S&P index, during COVID, the tech outperformance, the Russian war, the tariffs that have happened in the first half, despite all these challenges that have happened, we've actually had an upward trajectory in the market. The market has continued to rally. The market has continued. So there's money that has to be made, that has been made. If you look at it from the beginning in 2019, the index has actually doubled, moving from 3,000 all the way to 6,000. Levels. That is a significant growth across. That's 100% growth between the last couple of years that had been shown on the graph. So we have had challenges, yes, and we'll discuss these challenges as we go through this presentation. But just to look at the last 6 months alone, the first half has had two significant issues and two significant impacts that have happened. One being the tariffs. The tariff changes that were brought about by the current president of the US post coming into office, and the aggression that he came with in terms of tariffs across pushing back on China, pushing back on African countries, on Canada, Mexico, across board. That has brought a lot of uncertainty, and that uncertainty is seen in the market, and you can actually see a dive in the market in the last half, but the market has recovered despite those challenges. The currencies as well have suffered significantly. We have seen the same kind of uncertainty on currencies, on commodities, and basically on the fixed income. Talking of commodities, the tension that has been ongoing between Israel and Palestine and now Iran has led to a lot more volatility in the oil market as well, and the commodity side of it has also been impacted. So there's a lot that has happened in and that's why you're talking about the uncertainty, because you can imagine this is just in the last 6 months alone. We have seen significant impact. So when you look back a couple of years, it's a lot more in terms of uncertainty. The question is, what do you do in such an environment, and how do you maneuver such an environment and ensure, despite all these issues, you remain focused, you remain making money, you remain basically well informed as an investor. So globally, and I did say we'll speak about inflation, we'll speak about interest rates from an inflation point of view and basically a rates point of view. So The world went through COVID, yes. And before COVID, we did have the 2007 challenge, but all along we have had low interest rate levels. Post-COVID, we had a lot of stimuluses across board from countries just trying to manage and maneuver through this scenario. And that led us to having near zero interest rates. And that near zero interest rate environment in a scenario where we had challenges, and of course, that means a lot more money in people's pockets. The stimuluses did put money into people's pockets. Consumption did go up. But remember, we also had a lot of disruptions during COVID, and that supply chain disruption meant there was a lot more money in people's pocket, chasing a lot less in terms of commodities that were available. And that, of course, led to the levels of high inflation that we did see. So we did see inflation pick up post that, and that inflation picked quite a bit. We have the dots in black, which show you global inflation. But if you look at it and look at the red US inflation, that is, of course, in red, that really follows. The global inflation is on an annual basis, but you can see it actually tracks the global inflation, does track the US inflation. So the challenges that the US was facing, the challenges that the globe was facing were really similar across board. And that inflation level meant there must be a way to basically tame it, because you cannot have runaway inflation without making decisions that will actually help enable that. So the Russia-Ukraine war did come to add to it. And that, of course, is what pushed inflation even further, picking up at 9.1%. So mid-2022, we have inflation levels of 9.2%, 9.1%, which is, of course, significant across, but especially for the US. So how do you deal with this? The Fed started upping rates for the first time in a very long time, because even in 2007, when we had higher rates, we did not see rates as high as almost 6%, the 5% levels plus that we actually saw coming to the US. That was not the scenario. We had lower rates even then. So we have actually seen a significant jump in rates. And that significant jump in rates is what we are now talking about. So that jump in rates, which basically meant a lot of moving of dollars across and basically mopping up dollars across, is what impacted most of the other countries. And it also impacted Kenya. And we will also be looking at Kenya specifically and seeing how that played. So the higher interest rates, high inflation, how do you tame inflation? High inflation, and all this is driven by the uncertainty, the challenges we have brought by COVID, the challenges which basically was a health crisis, the challenges we had brought by the fact that we had stimuluses at that period, and the fact that we also had a war in Ukraine. All these uncertain moments, of course, led to a scenario where risk was perceived to be a lot higher, inflation went a lot higher, and of course, interest rates had to adjust upwards to basically tame inflation and tame the risk levels that we were seeing in there globally. Moving on to what this meant for Kenya. So yes, the globe was suffering across board. We had a scenario where rates did go up to tame inflation and basically deal with some of the other uncertainties that we had. So you have a high interest rate environment across board. What did that mean for Kenya specifically? So with the US having upped their rates, the US dollar did strengthen significantly. That strengthening of the dollar meant your currency, of course, takes a beating on the other side. So we did see Kenya get challenges because with high interest rates, there's a lot of movement of money across the US, given that we had come from levels of almost 0% in rates. You are now getting a 5% increase in your earnings. That is significant. That's basically a 500% growth in your earnings. With that kind of level of growth in your earnings, then you would definitely be wanting to hold the dollar. We also had a lot of other challenges that other countries were having, and we'll also speak to the challenges Kenya was having at that time, including the issues of sovereign risk. So we had a lot of money moving out of our economy, like any other economy, and dollars moving out of this economy, basically to the US. That led to a significant demand for the dollar, a strengthening of the dollar and a weakening of our currency. So the Kenyan currency took a beating, almost hitting levels of about 165 at that time. And the question was, what do we do about it? That coupled with the fact that we still had the same problems the rest of the world was having, which is basically the issue of inflation. And this is now coupled by the fact that we have on one hand imported inflation driven by the weaker currency and the supply chain issues that were going on across board and the shortage of commodities that came off the COVID period. So if you have a shortage of commodities, you have a weaker currency, you're importing a lot more in terms of inflation. So all your imports basically went up in price. Then to add pain to the injury, we also had a drought. So food prices as well went up. And when you look at our inflation, we had an increase, a significant increase, actually literally a jump, almost a straight line up, all the way to 9.5%. And that increase in inflation, of course, meant the government needed to do something. We needed to do something to tame that inflation. So the higher cost of household, the higher cost of living definitely had an impact on our pockets. But that again the pain was increased by the fact that interest rates did go up. So the CBK had to raise interest rates to tame inflation. As they were taming inflation, then of course it has another impact on it. So we had a strengthening currency, yes, and you can tell we did have a correction on our currency and went down all the way to levels of less than 130, which is where we are still sitting, but we will also be looking forward and seeing that. So that increase in rates did have the impact it was meant to have, which was basically to tame the weakening of the currency, which was becoming another crisis that was leading to imported inflation, and also tame the fact that households were having pain. So that increase in rates, on the other hand, also takes away a lot of money from the economy. So when you look at it from the impact of the central bank move to basically increase the CBR, so the CBR goes up, which means we have, yes, lower inflation levels because people have less in their pockets to spend. And because you have less to spend, you of course have a reduction in demand. And of course, the supply chain issues were also resolved with time. That of course meant also a strengthening of the currency. So that did happen. But even as that happened, we still had the pain of the fact that we had high interest rates. If you look at the 3-month treasury bill, it moved from lows of less than 8% all the way to 16. That's a doubling on the rate alone. That 16% did mean that you'll earn a lot more, yes, but it also meant that private sector credit growth was hit. If your borrowing cost has gone up, you have challenges in paying. We have seen the issues that we have had with non-performing loans, of course, and the fact that businesses have struggled significantly because there is a lack of capital. So you actually have a squeeze in capital, and that squeeze in capital meant, of course, you have a drop in terms of consumption. We do need to remember that consumption is a significant driver in any economy across board of growth and basically of how you invest. You invest based on the fact that there will be a consumer. You build a business based on the fact that the consumer has money to buy goods from you. That consumer, of course, also borrows from a bank. If they're not able to borrow, coupled with the challenges we had with the tax issues. So this did have a significant impact economically. And we will also speak to that because that did resolve one issue, but creates another problem. It resolves your currency issue, resolves your inflation issue, but it also gives you consumption problems, which of course lead to growth problems, which are some of the problems we're facing today. But that uncertainty doesn't go away. It still stays there. I do remember we had a lot of discussions on the Eurobond, the 2024 Eurobond. That did have a significant impact once it was repaid and mitigated on sovereign risk. Because remember, we price everything based on risk, and risk is very important in everything that you're pricing. And anything that is uncertainty is considered to be a risk level that you need to look at and basically be able to deal with. So we did have an increase in risk, which means an increase in rates and basically the compensation for the risk that you are taking. That did have a significant impact. CBK did do something about it. They tightened the policy, but then of course that means inflation cooled off, conditions did stable. But then, of course, it had an impact on growth. So when you look at economic growth, what are we seeing going forward? So the road ahead looks still has a lot of uncertainty, yes, but the road ahead looks slightly better than what it was. But we are still having the same pains that were caused by the fact that we had an increase in interest rates. Quicker consumer demand would mean that recovery will, of course, be a lot slower. Private sector credit growth with lower rates, because we have seen now rates have come down quite a bit, and CBK has cut the rates. That should, of course, drive private sector growth. But we do need to remember that that takes time. There's still going to be a lot more pain. There's still a lot of uncertainty in the country that is happening. So even by the time businesses do recover, by the time your pay slip and your increases do go up and you're able to basically take a bigger facility, that takes time, which means a curtailing of investment from a growth point of view, and of course a curtailing of consumption. So we do expect, yes, there will definitely be slow growth driven by the weaker consumer demand, which of course has an impact on businesses across board. And of course, the recovery that is expected in quarter two, in half two, of private sector growth should drive consumer demand slowly, and of course upscale the businesses as we progress. But then the problem that we had, remember, was a big challenge with inflation. Has that gone away? In our opinion, that has gone away. We do expect that with the favorable weather and the stable currency, we do not expect imported inflation. We do not expect challenges from a food-driven kind of inflation level. So we do expect that inflation will actually remain within the CBK range for the coming periods. And as that happens, then we do expect that interest rates will remain steady, supported by the fact that we have quite a bit in terms of liquidity across the market. So with steady interest rates, then that portends growth. But as I said, that growth, of course, comes a lot slower. From a currency point of view, I know we have spoken quite a bit about this, but from a currency point of view, we do expect the currency will still remain very resilient as we go forward, given that we have sufficient reserves. We do not have significant payments coming on our way in the near future. That we should ensure that we're able basically to keep our currency at a level that is sustainable. And given that most of the other economies are also going through the same. But the biggest risk that we face is the geopolitical side of it. That remains to be a big scare across board. We already spoke to the first half. On one hand, today we wake up to the fact that we have higher tariffs, we have a tariff war. The next day you actually wake up to the fact that we have an actual war in the Middle East. Those two remain to be a big challenge for us and across board. And of course, anything that happens across the globe does impact Kenya. So those have not staved off. We still have tariff discussions ongoing. We still have uncertain kind of discussions ongoing. We still have the same problems we have in Europe, Ukraine, and Russia is still ongoing. The Israel and Iran issue is still ongoing and still very alive. With us, tariff is still very alive. So the geopolitical side remains a big risk to the growth that we expect. But despite that, internally, we have seen a better currency. We have seen better rates of inflation. We have seen a more stable interest rate environment, which would, of course, speak to recovery even as we progress. But we still need to remain alive to the fact that the geopolitical side can very easily change and, of course, have an impact on Kenya even as we progress. So I'll move on to the next items because we have spoken to what we are seeing, we have spoken to what we expect, and yes, a better environment, but slow growth. So how do you take advantage of this? Because at the end of the day, all this information that we're giving you, we want to make sure that you can make a decision based on it. So yes, we do have subdued economic growth expected. Apologies for that. We do have a subdued economic growth expected. That is definite. We have also spoken to the fact that we still have geopolitical issues, and of course that brings a bit of uncertainty on the inflation side, but we still expect interest rates to stay higher for longer. So you have seen lower rates, but you don't expect them to basically go a lot lower than they have. We expect to be stable within the same level, which is still high. If you look at the history and where we have come from, we're still looking at a higher rate than what we're used to from an economic point of view. So those remain to be basically a challenge. And of course, the investment landscape will remain to be less predictable. But you still must take risk because the importance is a return is based on the risk that you're taking. That risk that you're taking will drive your return levels. And we have different levels of risk that you can actually take. I'll speak to the three commonly spoken to levels of risk: the low, the medium, and the high. From a low risk point of view, you can stay in a place where you know your capital is protected. So you have minimum risk to your capital, so that your money is safe. You have, of course, lower potential growth, yes, but the returns are also predictable and quite stable. And that is what money market funds and anything that is cash and near cash offers you in terms of any return that they offer you. So they are low risk, yes, but of course they also, as much as your capital is protected, the growth levels remain to be not as high as you'd want if you really wanted to make a lot more. From a medium risk point of view, you have securities that I would say it's more of a lending kind of structure, where you're either lending to the government, you're lending to a corporate, someone is paying you a fixed return out of what you're basically lending. So you have a balanced return. You've managed your risk is not as high as basically you would want. It's not as high in terms of risk. You have a balance in between your return and your risk. The returns are not extremely high. The losses are, of course, not extremely high. You still have some insulation, and you, of course, have a stability out of it, because the moderate risk levels. So you can either lend to the government through treasury bonds, you can come into a fixed income fund, and the fixed income fund, of course, invests in fixed income securities, which would be treasury bonds, the T-bills, and anything else. And I know Dominic will be speaking to that. We also have structured notes that basically provide an insulation. They do give you exposure to some of these assets, but they also basically provide an insulation against losses. Then you have the higher risk instruments, and this would be you're taking ownership. You're buying into a company, and that is what basically buying shares means. You're buying a share of an institution. So you're taking higher risk. You, of course, do expect to have a higher return out of it. And of course, you also have the risk of a higher loss out of it, a lot more volatility. But what I would recommend is a mix of the three. At any one time, you should have a mix of the three. And that mix between the low, the medium, and the high is what ensures that you have a very well-balanced portfolio across board. You start, of course, by saving your money. Once you save your money, which is basically the cash, you invest it in a near cash environment, which is very liquid, which is basically what the money market fund would offer. And once, as you progress and the amount grow, you can now go on and lend. And that is basically where you lend to government, you lend to corporate in different structures. And once you build up quite a bit and you have some money that you can take some more risk with, you go into ownership, and you basically can buy into an institution through the equity, the stock market, through a fund as well. The beauty with funds is that you don't have to be the one who makes the decisions. You have experts who make decisions on your behalf, but they invest in the same securities that you would be investing into. Balance funds offer you a balance of the two. You have ownership in it, but you also have some fixed income portion in it, which means you still are taking higher risk, but slightly lower than having full ownership or you're investing in equities. So what strategies do you use even as you buy into these instruments, even as you make these investments? There are strategies that will ensure that you take away the volatility and you take away the risk of basically buying and making investments in a very volatile market. The first strategy is to ensure that at any one time when you're making any investments, that your individual financial goals are very clear. Your time horizon, how long you're going to invest, what level of risk you're willing to take with the different amounts that you have, because we said you basically need to invest in all the three segments of risk. As you invest, you need to be very clear. I may put in 20% in high risk assets. I may put in 20% in medium risk. I may put in 20% in low risk. What portions am I assigning to each? So that you're very clear in terms of the risk tolerance for the different portions that make up your basket of the assets that you're going to be buying. With that, and of course, that is driven by your financial goals. What is the money actually meant for? What are you trying to achieve? How long can you put the money aside? If you can put it aside for 10 years, then of course you're looking at high risk kind of investment, and you can put money away for 10 years. If it's money that only will be needed in the next 6 months, then you of course will be looking at something low risk that ensures that the money is safe, but still earns you something even as you progress. So your financial goals, your investment horizons, and your risk tolerance are very, very important in whatever strategy you're picking, and you must make sure that they are aligned to that strategy. Then in very uncertain environments, our recommendation is anything you buy, you hold it for a lot longer. The timing of the market, and I know Dominic will be speaking to some of these myths, portend a lot more risk. Yes, they have opportunities, and I'll speak to this from a high conviction point of view, but a buy and hold strategy in a very volatile environment ensures that you actually are purchasing investments and holding them regardless of the short-term measures that you're seeing. As I showed in the very first graph, we have seen growth. Yes, we had COVID, we had the Russian challenge, we had the growth that came, we have had tariff, but we have had a doubling in terms of value in the US. And that is the same scenario I've seen across quite a number of markets. So to be able to work across, you buy and hold, ignore the short-term challenges and fluctuations and basically volatility that you're seeing, because you're making decisions that are well-informed and are basically long-term. That ensures that you ride the wave despite the challenges, and you, of course, buy incrementally as you progress. And at the end of it all, several years later, you find that you've actually built a very good portfolio with some very good money on it. The other item is make sure that you're diversified. We have seen risks portend in different asset classes. and different sectors. Different sectors were hit by different items. Different sectors they performed very differently, whether it's the financial sector, whether it's the health sector, across board. So diversification is very, very important. You make sure that you're diversified. So that in case in a period of high volatility, which basically means a period of high risk, if a certain sector is hit hard, you don't want to be 100% in that particular sector. You may not be able to recover. But if you're well diversified, despite the challenges that may happen, you will always have sectors that are doing better and sectors that are suffering. And that ensures that you actually can maintain your return and, of course, manages your risk quite a bit. From an asset allocation point of view, in periods when you have high volatility, remember I asked, are you putting 20% in high risk? Are you putting 20% in medium? What percentages are you assigning? Would recommend an allocation to the less risky segment, ensuring that your capital is safe and is secured. You don't put all your eggs in one basket, yes, but ensure that you increase your allocation to the low risk and the medium risk assets. That ensures that your capital is safe and gives you regular income, which you can reinvest, because that investment is very important. And as you reinvest this income that is coming in, you're of course reinvesting them at higher returns and higher interest rate levels, which portends to earning you a lot more in terms of income, and of course cushions you against the sharp market declines that might come with the high risk assets that you may be holding. Then finally, having an informed decision is extremely important. Conviction, a high conviction trading comes from the fact that, and this basically applies largely to the high risk assets, you must make sure that you do your research thoroughly, it is well informed, and you have the conviction that you need that this particular asset I'm buying will make money. Because you're taking a very high risk. Take time to evaluate, take time to walk a journey of making sure that you actually do evaluate this risk significantly, look at the numbers, be sure. Where you have challenges in this, that's where you walk a journey with a financial partner, you visit us, or you get into a fund. And the beauty of the fund is that the people making the decisions have walked this journey a lot longer. They have done their 10, 15 years. They have seen a lot of these fluctuations and have been able to basically know how they wave through them. That ensures that you basically are insulated. But making high conviction trading in such scenarios can portend to giving you some very good income out of it and make you some very good income, money, but it also can portend to you losing a lot of money out of it. So the evaluation of the same and the process that you go through to make sure that even as you make a high risk investment, it is very well informed and you have the conviction that you need to be able to make that decision. That is it from me, Fiona. I'll hand over to you for any questions that may be there from the session. Thank you very much.
Thank you. Oh, thank you so much, Mwenda, for that very, very insightful presentation. And honestly, for me, some of the key highlights are really just need to align my investment strategy with my personal financial goals, and diversification is key in this very volatile environment. And so thank you so much. We have quite a number of questions for you. I think it speaks to the insightful presentation that you've just shared with us. So let me just go straight to the questions. We have a question from Michael Miner, and he's asking, what were the causes of global inflation? Wanda.
Thank you. So the main cause of global inflation was the fact that we had two-pronged items. We had stimuluses across board post-COVID. That means a lot more money in people's pockets. Consumers had funds. They could actually buy a lot more in terms of commodities. But we also had a shortage in commodities because of the supply chain issues. Remember the issues we had moving goods from China across board, and of course moving raw materials to the production environments. So that kind of environment portends that you have a shortage of goods and a lot more people chasing the same goods, which means a higher price. That higher price is what basically is rated as inflation. So you have an increase in prices, you have an inflation in prices. The inflation in prices was driven by the two-pronged items, which was a lot more in terms of money supply and a shortage in commodities. As I said, that has dissipated as the issues went away in terms of supply across board and the ease of moving goods across board. Then we did see the supply issues go down and basically come a lot lower. Again, we did, as consumers, as interest rates went up, we did see a reduction in money supply, or rather the amount of money that consumers had. And of course, that has staved a bit of the consumer demand. So you have a reduction in consumer demand, you have an increase or rather a lot more efficiency in terms of supply. And that of course led to lower inflation as well. So the same problems that led to higher inflation, once they're resolved, you also, of course, have lower inflation.
We also have another question from Michael. Thank you, Michael, for being engaging. Are more people investing in Kenya, or are they cautious?
A lot of the challenges we have had across the globe did hit Kenya, but Kenya also did react quickly to some of these challenges. And if you look at our stock market this year, we are up more than 20% through half an year. A lot of our institutions fundamentally remained strong. If you look at it from the likes of Safaricom, the likes of the banks, including ABSA, there has been a significant growth over the last couple of years, which has not been reflected because of the challenges we have had from a risk point of view. So as rates come lower globally, there will be need for people to basically look for chase return where it is. So as we have had the challenges, people are moving away from the US because of the challenges the US is having. We have seen a lot of demand locally as well, and from foreigners into our markets, and that has seen the growth that you have actually seen in the market. So this is the time to make whatever investments you need to make. Yes, we have suffered over the last couple of years, but definitely we have seen a lot of recovery. We did see a recovery last year. We have seen a recovery this year. And as I did indicate, with the lower inflation levels, managed interest rates, a stronger currency, we do expect growth. Yes, slow, but definitely going through a recovery. So it would be a good time to basically invest in Kenya and make investments to enjoy the recovery and basically ride the wave in this recovery period. Fiona, thank you.
Thank you, Mwenda. I have another question from Isaiah Bonyo. He's asking, what's the current average interest rate in low risk, medium risk, and high risk portfolio? It's an interesting question. What's the average interest rate in low risk, medium, and high risk portfolio?
Low risk portfolios generally do give you a single digit kind of return because they are pegged on slightly higher than what your CBR would be, which is slightly higher than what your inflation would be. So returns are pegged generally on inflation. So when you have most of Kenya's inflation has been single digit for quite a bit of time. We have seen experiences where we have seen slightly higher. The CBR has also been single digit. So you'd end up with a low risk return on average of a single digit, less than 10%. As you move to the lending side of it, again, you do see slightly higher than that, levels of between 10 and 15% in terms of return on average. The average T bond would give you about 12% return or slightly higher. Exceptions, of course, do apply, but that would be the level of return that you'll be looking at it from a medium level. When it comes to high risk levels, they fluctuate. You have higher levels of risk, which means you have higher losses, higher returns, but anything above that would happen. As I said, we have seen recovery across the stock market. Last year was 20-something. This year, we have already seen the same levels year to date. We do expect that we'll definitely be seeing levels of 20% plus in the stock market. So that would be the level of return that we'll be looking at. But remember, a lot of the high risk levels is really not consistent in terms of return, but your fluctuations across board. But if you do sit in the market for quite a bit of time, you should be able to average your return to a reasonable level of about the levels we're seeing of 20-something% across board, Fiona. Thank you.
Thank you, Mwenda. And I know Dr. Wilson had asked a similar question. What is the current average interest rate for AML? I think you've been able to answer that through the previous question. I have a very interesting one from Dominic Ombogi, and he's asking, and he's first commending you, says, very good presentation. From experience, is it possible to get a net return of 20% in this economy? Mwenda.
It is possible, and I did indicate that last year the stock market did have a 20% plus return. The same thing actually happened in the fixed income market. With interest rates going lower, we did see an increase in value, and that increase in value did come almost to levels of 20% last year. So as I did say, a higher risk, higher return, but also you have the potential of higher losses. So as you put your basket together, you want to know what amount of money can I actually risk? From a high point of view, which amount of money chases the high returns, which amount of money am I willing to put aside just to ensure that I do earn a return that is competitive, but not extremely high. And what amounts am I putting aside basically for either meant for emergency or for your own sustenance, which will be, you don't want to risk the capital. But where you're taking risk or you're actually risking capital, then 20% plus returns are possible in this market, but you need to be cognizant of the risk that you're actually taking. The risk you're taking is the risk that you can get your capital wiped out. If you're willing to risk your capital, chasing the return, then yes. But if you're not willing to risk your capital chasing the return, then you want to look at either the medium risk or the low risk kind of scenarios. So having a basket where you have a mix of them, of course, gives you quite a bit of an advantage where you're not losing out on the very high returns, but you don't put all your money in high risk investments because you can actually have that wiped out. Thank you.
Thank you. I think we can take a final one for now. But heroes, please keep the questions coming, and thank you so much. We're getting so many questions and comments, and we really appreciate the engagement. So just a final one from Bridget, so that we can proceed to the next speaker. How is inflation affecting consumer purchasing power?
So yes, in terms of consumption and the consumer purchasing power, we have spoken to the fact that we actually did have a reduction, a significant reduction. When you see an increase in rates, it means banks are not able to lend to the levels they're supposed to. Of course, we as borrowers, we are not borrowing. We have seen an increase in taxes as well, which takes away from what you spend on your payslip as well. That squeeze in spending has happened. With lower interest rates, we do expect that will dissipate with time, slow but sure. It will definitely take time before we get consumer demand to where it was before the high interest rates came in, before the tax issues came in, but it is going to happen. It has already begun. We do expect a bit of a recovery in private sector growth in this particular half that we are heading into, and we do expect that basically will continue even into the next year. But it will be slow, but we do expect consumer purchasing power to basically go higher, given the fact that most of the issues we had, whether they were inflation, whether they were interest rate issues, whether they were currency issues, they have been managed with what the CBK has basically done in the recent past. Fiona, thank you.
Thank you. Thank you so much. Wenda, we have so many other questions, but for now, allow me to pause on that so that we introduce our next speaker, and we'll be able to take the rest of the sessions after the presentation. So we go straight to it. Heroes, allow me to introduce you to our next speaker for the session, Mr. Dominic Njehia, who's a seasoned client relationship manager with over 20 years experience in business strategy, and is currently serving as our head of business development here at Absa Asset Management Limited. Dominic, over to you.
Thank you, Fiona, and thank you, Mwenda, for that good presentation. Our clients, thank you. We want just to introduce what Absa Asset Management is as a fund manager. We have been in business for the last since 2009, and we are registered by Capital Market Authority and Retirement Benefit Authority. We have various propositions that we offer at Absa Asset Management, and basically this is to look at what Mwenda has taken us through, all the areas that we look after, and especially the pension, the wealth management, and corporate trust treasury services. If you look at the pension side, we have what we call the discretionary pension mandate, and this is where we have corporate with a segregated mandate. This means that they have their own pension funds, and we look after that as a fund manager. And as per the LBA regulations, we also look after the guaranteed funds as a fund manager. We have 5 collective investment schemes. This is where we call them unit trusts in this market. And we have the 5 unit trusts. One is the Kenya Shilling Money Market Fund. We also have Kenya Dollar Money Market Fund. We have a bond fund. We have a balance fund, and we have also an equity fund. In terms of wealth management, we look after, or we do help our customers, our clients to acquire treasury bonds. We also do Euro bonds, offshore structured notes, and Sharia compliant structured notes. In terms of pension also as an umbrella fund. We look after individual pension plan. This is where an individual like to do a voluntary investment for his retirement as an individual, and also as a corporate, and you don't have to look after to do a segregated mandate. We also have an umbrella fund which is registered by Retirement Benefit Authority. In terms of corporate assets, we have insurance assets. This is where the insurance assets, especially the premiums that they correct, they appoint us as a fund manager to invest up the portfolio for the return, depending on the risk and the return that they're looking after. And also, we also look for businesses that have extra cash in their balance sheet, and they would like to have a portfolio or to be managed by the fund manager. That also we do as ABSA Asset Management. If we deep dive basically to look after money market, and basically why the money market sometimes they are very famous or very attractive in this market, we look at the benefits that they offer, especially looking at what Menda has presented in terms of capital preservations. They invest in a very short-term, low risk and short-term instrument. So their capital is very preserved in that perspective. They offer a very high liquidity. That means you can access your fund at any one particular time. The funds are very stable. If you look at the stability of the fund of the money market fund since we started in this market almost 25 years ago, they are very stable and making a dependent income. You can project and say this is the average that might be getting for the next 2 or 3 years. The funds carry low risk and to their investment because of the high quality short-term debts they offer. They are very good regulated by Capital Market Authority. They offer diversifications because they spread investment. The investment is done as a portfolio, and they have multiple assets, underlying assets in that portfolio. The investment is managed by a professional. Fund managers are very good professionals. They look after securities, the selections, and the risk management aspect of the fund. Withdraw minimum investment. They give all the investors very good entry levels, because regardless of the amount that you have, you can always access these funds. Even if you have your 10,000, 5,000, 100,000, you can always access this money market fund as enjoy those rates that the money market funds are offering. So who can invest? Money market funds are open to any entities in this market. You can look after circles, individuals, SMEs, NGOs, schools, any churches, chamas, organization, government, or corporate. Any legal entity can invest in money market and enjoy those benefits of the money market. The fund accepts ABSA existing clients and also non-ABSA clients. So stabilities you can count on, liquidity when you need it at any one time. If you look at a glance, how they have been performing for the last few days, if you look at effective annual rate, and this is the yield as at 7th of July 2025, ABSA Shilling Fund, which invests in a very short-term interest-earning assets like treasury bills and all denominated in Kenya shillings, was offering around 9.39%. If you look at the dollar fund, which invests in short-term dollar-denominated assets like credit-linked notes, was offering 4.4% per annum. If you look at the fixed income is invest in a pool of funds, invest in debt securities like government bonds, but it's a bit long-term, it's not short-term investment, but looking how it was performing as at 7th, it was offering 11.72%. Equity fund is net asset, is reported as a net asset value of 121 per unit, and the goal was to invest in a suitable investment, high return, and taking a high risk, because it invests in securities, but it can offer a very good return by the end of the period. If you look at the balance fund, it's a diversified fund that combines both equities and fixed income in a single portfolio of balanced risk, which balance risk and return. So it gives you a moderate kind of return. You're not very conservative, you're not very aggressive, you're in between that risk appetite of balanced mandate. So how can you invest? It's a very simple process. You just need to fill an application form, you attach your KYC document, or any other required document that is required by the fund manager. If you look at the facts and facts on investment, and basically looking at the challenging common myth of investing, we're looking at, sometimes we look at you need a lot of money to invest or to start investing. The fact is, you don't need a lot of money. If you look at a money market fund, you can always begin as little as 1,000 shillings, and you can build up that fund as a saving platform at in one time. The other myth that we were looking at is investing is only for experts. Investing is not just for experts. Beginners can start with a very simple strategy, so you don't have to have very complex strategy to start investing. You must constantly monitor the market. No, you don't have to monitor. People invest long term and check their investment occasionally. You don't have to keep on checking the market on a daily basis. You can invest and wait and hold, as Mwenda said. The other myth is timing the market is key to success. You don't have to. You don't have to keep on timing for you to be successful. You just need to be consistent. Long-term investing usually works better than in trying to predict the market when it's high or when it's low. It is too risky. No, it's not too risky. All investing involves some risk. You can reduce by choosing safer options and investing in a long term. So the best time to start investing was yesterday. The next time investing is today. So I'll stop there. I'll take it back to Fiona. Thank you.
Well, thank you so much, Dominic, for that very, very concise presentation on the offerings that we have and the various investment options that are out there for our heroes. So I think, let me just see what I can check here. We have a number of questions. There's one from Peter Kimuli. I know you had two questions, but we can start with this one. So Dominic, for the equity funds, do you share information on the underlying investments?
Yes, we do. We have a fact sheet that shows all the underlying assets that we have invested in that fund. We shared it every month, and we can also share with you after this presentation. Thank you.
Thank you, Dominic, for that confirmation. Michael Miner also has another question for you, Dominic. Is my capital guaranteed, or can I lose part of it? Is there a minimum amount I must invest or withdraw?
As Mwenda took us through, all investments have a bit of risk in the end of the day, but the risk depends on low risk, medium risk, and high risk. If you look at, if you want to manage your risk better, especially if you don't want to take a lot of risk, you invest in what you call the money market fund. So the risk is so minimal. So the risk of losing your capital is very minimal. So the fund is well guaranteed, is well managed, well governed by Capital Market Authority. The regulations are quite defined. So in the end of the day, that managing of that risk, you are very, very sure that even if anything happens, it's a very low risk investment, but it will give you a quite kind of return. So the minimum that you just need to invest is only 1,000. You can build it up from there. Any amount you can enjoy to invest in a money market fund with us. Thank you.
Thank you, Dominic. Just to encourage our heroes, thank you for keeping the questions and the comments coming. We should be able to answer each and every one of you, so keep them coming. Dominic, let me pivot slightly away from you, go back to Dominic, because we're also still getting a lot of questions with regards to the investments and the economy. So Mwenda, we had a question from Isaiah Bonyo, and he says, we have had competitors offering returns on fixed income average greater than 18%. What's your take? And among the three portfolios, which one is more or less similar to fixed income? Lastly, what does this fixed income mean? So just expound on that for us, Mwenda.
Thank you, Fiona. I'll start off with the last question, actually. What does fixed income mean? I'll give an example. If you buy a share in a company, they pay an annual dividend, but this dividend can change. It can go higher on 1 year, and there are some years, depending on how the institution has performed, that you'd actually have no dividend being paid because it's a factor of the return that the institution is making. Institutions do fluctuate in terms of their earnings and therefore can pay you unexpected returns. So the return is basically the income that you're making is not fixed. Dividends are never fixed. Dividends are declared on an annual basis and can change. Whereas if you buy a fixed income instrument, for example, a bond, or you go into a fixed deposit, the income is actually fixed. Buy a bond that pays you 12%, and the government says they'll pay you a coupon an interest every 6 months. So they're paying you that 12%. If it's a 25-year instrument, if it's a 10-year instrument, your income is fixed that you'll actually earn 12% every year for the next 20 years, for the next 15 years. That is basically what the fixed income portion means, that you have a fixed portion. Now, what we have that is similar to that is a fixed income fund, or what you have, Dominic, called the bond fund. What a fixed income fund does is that it invests largely in fixed income securities, which would be government bonds. But then again, unlike a money market fund, a fixed income fund also factors in the change in price of the asset because bonds are actually tradable. They are tradable. You can buy and sell a bond. You can buy it at a higher price, sell it at a lower price. And that's the reason why we have seen some of these very high returns last year. Fixed income funds did have two-pronged. You have the income that is coming in, which is basically the interest, which is the 12% that you're earning, but you also have a change in price. As interest rates go up and down, prices change. So when you have interest rates going higher, fixed income securities adjust in price downwards. They actually have an inverse relationship. So as rates were coming lower last year, what we had was an increase in price. So last year was actually a different kind of environment than what we had seen in the previous years. And that's what's saying last year we saw recovery, both in the stock market and also in the fixed income market. That recovery is what you're seeing in terms of return, double-digit returns of 18%, some as high as 20%, because it's coupled both by the interest you're earning, but also in the change in price. So that change in price is also factored in as part of your earnings for the year. And when you look at our fixed income fund, what it's earning is 11.75. And that's why we publish both a rate and a net asset value. The rate captures what it's actually earning, which is similar to the fixed income that it's actually earning. In this case, that is 11.72, which remember is net of all fees. So there's an earning of 11.72 that is coming in. That is basically what comes from the interest that is earned by these instruments. But then we also publish a net asset value, which adjusts accordingly as the prices at it adjusts. So the net asset value has both the income of 11.75 that you're earning, but it also has a change in price factored in it because it now gives you the value of the asset. And as I said, the value of the asset changes depending on the direction interest rates do change. So we also did have a significant growth and a significant return on our fixed income fund. And our fixed income fund is already similar to the other assets, as I have said, Fiona. I hope I have answered all the questions. I believe I have, and I hope I have been as comprehensive as possible. Thank you.
Yes, thank you, Dominic. Thank you, Mwenda. Sorry, that was quite comprehensive. Let me ask you one more question, Mwenda, before we go back to Dominic. So there was another question from Peter Kimuli, and he said, first of all, many thanks to the ABSA team for this presentation. My question, at what point of the capital cycle do you think Kenya is? Capital flows, leverage levels, that is sovereign or company-wide, real wages, etc. Do you see market level drivers for growth looking out? I don't know if you got the question, Mwenda. Is it clear?
Yes, I'll take that. So thank you very much for that question. So we have seen a lot of changes, and I know I've discussed those changes as we progress through and just walk through the journey, because it was important for us to just walk you through the journey of what exactly has been happening globally, what has happened locally. At what point is Kenya at? I did speak to the fact that we believe Kenya is at a recovery level. We have seen a lot more interest in our market. And that is the reason why we have seen a recovery last year. We have seen a recovery this year. We actually seen a stronger currency. We have seen a better environment from an inflation point of view. All these portend and speak to any investor. Lower risk levels where you can still make a very good return because we basically do expect a recovery. So from where we are seated, with lower sovereign risk, with the lower inflation levels, with better environment from an interest rate point of view, where we're expecting to see consumer demand coming in on the foot of growth in private sector credit growth, then we do expect economic growth to basically pick up. And that's why we do believe that this is a time to actually put your money in Kenya. We have seen that already happening. We already seen a lot of interest. And as we say, the stock market is a barometer of the economy. You can tell what the investors are speaking, what the investors are seeing. You can actually tell it shows what we expect in the future, because fundamentally the institutions have remained very strong. Fundamentals have remained very strong despite all the challenges we have had, and we have still seen growth across. We do expect that growth to continue, and we should see markets recover even as we progress into the next period. Fiona.
So in short, we have to start now. And so thank you for that. Dominic, I think we go back to you. We have a question here from Joel asking, what are the management fees for unit trust funds?
Thank you, Fiona. Thank you, Joel, for that question. Management fees for various unit trusts depends on the funds themselves, and they varies between the funds. If you look at the money market fund, insurance fund for Absa Asset Management, the management fee is 2.5%, and the returns that we publish are net of that. So that means that the 9.7% we have already taken care of, or 2.5%. If you look at the DORA fund, which we are returning 4.4%, the management fee is 0.5%, and we have already taken care of that. So that is net of management fee, the 4.4%. For the other funds, the fees for balance, bond fund, and equity fund, all of them are 2% per annum. So the fees are prorated, and they are calculated on a daily basis before the distribution is done. So the rate that you see either on paper or in the board has already taken care of that fees of each and every fund. Thank you, Fiona.
Thank you, Dominic, for clarifying that. We usually get a lot of questions here on the rate that we're publishing. Is it net or gross of our fees? So thank you so much for making that clear to our heroes on the call. Dominic, another question from Emmanuel says, can I use unit trust as an emergency fund? If so, what is the turnaround time, and what is our current assets under management? Maybe you can shed some light on that.
Thank you, Emmanuel. Yes, you can use unit trust or money market fund as an emergency fund because it's very liquid. You can always access these funds within a period of 72 hours or less than that. So it's a very liquid asset. You can always liquidate either partially or the whole amount. So it doesn't matter how much you have, because the calculation of interest is done on a daily basis. So even if you have 100,000, you need 10,000, you can always access the 10,000 that you need, and you leave your 90,000 earning interest. And the same, you can also use it as to top up or to save. If you have 100,000 today, tomorrow you get 10,000, 5,000, you can use that account like any other, investment transaction account. That means you can top it up anytime, you can withdraw at any one time. Currently, we are at around 25.5 billion Kenya shillings in money market fund, in our funds, especially the unit trust, which we have grown for the last 3 years or so. And we thank the heroes for the support that you have given us, and also you have faith with us as an asset manager to manage your funds. And we have grown the funds for the last 3 or so years. Thank you very much, Emmanuel.
Thank you, Dominic. Let me ask you one more before we pivot back to Mwenda. So Bridget asks, what risks are there in the money market funds? I think this is important for those on the call, just to kind of understand the risk associated with some of these funds. So what risks are there in money market funds? Dominic.
Thank you, Bridget, for that. As we said, the risk is always determined by the underlying assets. Whatever asset that you manage or you buy in that portfolio, that determines the risk that you take. The risk means that the funds that you're collecting from the public or from the investors, you have to invest in a certain assets. And where the fund manager is picking those risks, those assets, he has to do risk management in terms of what he has or she has to buy. And those funds means that you can buy a T-bill, you can buy a deposit, you can buy a corporate paper, you can buy a bond. That's the only risk that you take, because the underlying asset determines the risk that you take. The other issue is that the fund manager has to take care of is the third-party transactions, because the funds are regulated by CMA, and you are required to be compliant with the CMA regulations. And some of those assets that you're buying, you are required not to have at most maybe above 10% sitting with one entity. So the entities that you invest in, especially the third party, if you're giving a bank, if you're buying a bond, you're buying a corporate paper, that's the third party transaction. That's where the professional need to do, especially to manage that risk. So selection of assets, there is selection of the third party transactions, or the selection of the parties, that parties is where the risk lies. But for ABSA, we are very lucky, because that's one of the areas that we take very cautious decision, especially to do with the third party transaction, maybe the tier 1, tier 2 banks. That's where we play, or the asset that we have to take in terms of the T-bills, the proposition, the number of assets that we have to buy. We have very good risk management strategies at ABSA. Thank you very much.
Dominic, for that. Quite reassuring that our money is safe here, ABSA Asset Management Limited. So, Mwenda, let me come back to you. An interesting one from Grace Mbugi. I'd like to hear your thoughts on the same. And Grace asks, can you advise what MasaX are doing differently to have quarterly high interest?
Thank you, Fiona. I may not mention and provide details on what our competitors may be doing, but let me speak to the fact that return is tied to risk at any one time. The underlying assets, as Dominic has put it, are extremely important for you to look at and ensure that whatever the underlying assets are assets that you understand, that you know where the money is coming from. If you're not clear as to where the funds are coming from, where the return is coming from, then of course it becomes a challenge to you. It's very important to ensure that you understand the underlying assets, understand what is this person investing in. When you look at our funds, we have very clear naming and clarity of where we put our money in. If it's a money market fund, it's short-term and very clear. If it's a fixed income fund, it's also short-term, and I mean, it shows you we are putting our money in fixed income assets. If it's a balanced fund, it's a mix between the equities and the fixed income side of it. If it's an equity fund, it's of course in equities, which would be in this case our shares. So we are very clear as what assets are we buying. And given that these assets are not complicated assets, the assets that you very easily understand. You'll understand a T-bill, you'll understand a treasury bond, a treasury bill, a treasury bond, you'll understand a share, whether a share of Safaricom, a share of KCB, and you can evaluate whether these institutions are doing well. Ours is to evaluate and make sure that we actually take in risk that is measured. And as we take this measured risk, we provide you a return that is actually risk adjusted, because we don't want to expose you to risks that are higher than should be. Our expertise is ensuring that we do our management and our portfolio selection with a lot of insight, so that you deliver the return without risking the money. So the risk still remains, but the level of risk is determined and basically measured, and we make an investment based on that. And that, of course, tells you what kind of return you would expect from a money market fund, from a fixed income fund, from an equity fund. The return levels are different, the risk levels are different, the fluctuations are different, the volatility is very different. And of course, in uncertain environments, you want to ensure that the assets that you're investing in have less risk, have less uncertainty, to ensure that you basically have a store of your capital during the very difficult times. So we are clear as to what the underlying are, where the return is coming from, and that is very important. So even as you evaluate any of the other offerings that are there in the market, because they are diverse, it's very important to basically lift the veil and ensure that you understand the underlying assets that are giving you this return that you're seeing that is being published. And that's why we have fact sheets across for all our funds, and we publish our fact sheets on a monthly basis. And those fact sheets do show you the underlying assets that you have invested in, so that you know where the return is coming from. Because the return, of course, is coming from one of those assets that you've invested in. Thank you very much.
Thank you for clarifying that. So just to reiterate, understand the investment that you're undertaking. Just to appreciate where the returns are coming from. I think that's well understood, loud and clear. Thank you, Mwenda, for that. Mwenda, I'll still ask you another question or two before I go back to Dominic. There's another follow-up from Peter Kimuli, and he said, thank you, Mwenda. Fiona, do you see a deleveraging in the banking sector? What factors would swing this one way or another? Apologies for the many questions. You don't need to apologize, Peter. We appreciate your questions and your comments. Mwenda, hope you understood that and you can take that.
Yes. So the banking sector has gone, is the bedrock to a large extent when it comes to consumption, when it comes to money supply, when it comes to private sector growth. So over the last couple of years, with the higher interest rate environment, we have seen challenges in the banking sector. The banking sector has seen higher non-performing loans because with higher rates, of course, your clients do struggle to pay. And as they struggle to pay, then you have a challenge. The same client as revenue that is coming from consumption. This consumption may be driven by a borrower was borrowed from you, or rather the challenges we have had in the economy. As consumption has gone down, revenues have gone down for institutions, and as well the revenue lines of individuals, which in this case, just to speak of the payslip has, the purchasing power has been impacted because of cost of the taxes and the other items that have hit the payslip. So with a reduction in purchasing power, with a reduction in consumption, of course, that means a reduction in revenues for institutions. A reduction in revenues for institutions means challenges in paying, whether you're payslip based, whether you're business, you have challenges in servicing your facilities. And of course, the high interest rate environment did not help. You have higher rates, so you're already struggling from a revenue point of view. You're now struggling with the repayments which have gone up. It becomes very difficult to be able to service this. And that lack of servicing has, of course, hit the banking sector significantly. But banks have been able to find other revenue lines where they have made money and basically progress to ensure that they deliver as institutions. But from a lending point of view, the struggle has been there. We have seen that. Now with lower interest rates, we do expect some of these things to basically go away. One, the fact that you have lower interest rates means the repayments are lower, and we should expect that ideally, the struggles we have had with non-performing loans are also going to be dissipated. And as lending starts to pick up, as private sector credit starts growing, as payslips start recovering and people basically take top-ups and take more facilities, we expect consumer demand to start going up. As I said, the growth and the recovery will be slow, but it will happen. We have already started seeing that, and we do expect that in the second half to basically start picking up as rates remain low. And as that continues, as consumer demand starts peaking, then of course the businesses, we start seeing a recovery in their revenues. And as the revenues recover, then they'll also come into the market to borrow and make investments, because you make investments because you know the commodities you're producing, the commodities you're buying will have a buyer. So consumer demand is extremely important, and private sector growth also does drive that portion. So we do expect that the recovery will happen. We do expect that banks will, of course, see a big chunk of that revenue coming their way, and will be some of the biggest beneficiaries. So yes, the struggles are not over, Peter. The struggle remains, but definitely slow but sure recovery is coming our way. And we do expect that even as we progress, we'll definitely see a lot more growth in the banking sector. Thank you.
Thank you, Mwenda. I think that has been well answered. So heroes, again, just to continue to encourage you, please post your questions and your comments. We still have 15 minutes and we are here for you to answer any questions that you may have for us. Mwenda, I'll ask you one more before we go back to Dominic. So we have a question from Alois, and he says the money market returns seem to be getting lower and lower. When and how low do you project these returns to fall before recovery?
Thank you. So the reason why we offer products across the different risk levels is to ensure that during certain periods, you can take advantage of certain items. Now, during very high risk levels, periods where we actually are seeing a lot more in terms of sovereign risk and a lot more in terms of challenges, what happens is interest rates basically go up to either deal with those risk issues, whether it's inflation, whether it's a weaker currency, and all that comes on board. So you have money market funds earning a lot more during those periods. So in other words, you have a lot more interest in low risk and assets, because of course you have higher risk in other segments. As things change, then you have a movement away from that. So you have, of course, the money market funds seeing lower interest rates as we progress. So the thing with short-term assets is that they adjust as the market adjusts. So if we have a cut in interest rates, we will see the interest rates go lower. If you have an increase in interest rates, we see the interest rates go higher. So they track the interest rate environment, earning you higher and above inflation, earning you higher and above the CBR rate, ensuring that you're actually being compensated for the investment you're making, but they do track the interest rate environment at all times. And that is what short-term interest rates do. They basically insulate you against risk, but track the level of risk that is available and adjust accordingly to compensate you for the level of risk that is in the country at any one time. Now, as you progress to the other the other assets, then you do expect that to be on the opposite side, where during high risk levels, you of course will register high losses, and we did see the stock market suffer as interest rates went up. We saw fixed income assets, of course, adjust downwards as well, and they took a beating, quite a bit of a beating. We did see the recovery start last year, but we definitely did have losses being reported on these items because the risk levels that are present are of course reflected. So we do expect a lower interest level on our money market funds, given that most of these risks that were present have dissipated. We expect rates to remain a bit more stable and for a longer period. It's still not as low as we have seen in the past. We still do see these rates remaining at not at the same levels we're seeing today. So we don't expect a jump in rates. We do not expect a significant plummet in rates as well, but we speak to the fact that they're actually tracking what is happening in the market, given that they are low risk. It's a low risk instrument, and this would be the time you'd actually be looking at the higher risk instruments and looking to basically up your allocations to the fixed income funds, the balance funds, and the equity funds to be able to make up, and also structured securities that we do have for higher ticket amounts. Thank you very much.
Wanda, I think that speaks to the diversification that you had talked about earlier, actually, during our presentation. So that, I think, has hit home well. Dominic, I think we go back to you. We have an interesting question from Isaiah Ponyan. He's asking, why are your management fees higher than your peers? Average stands at about 1 to 1.5%. Please advise on this.
Thank you. Thank you very much. Management fees are regulated by Capital Market Authority, and we get approvals from CMA on terms of management. But the management fee are based on fund under management and is calculated on a daily basis. And this 2% is per annum. It's not per month or per transaction. But they are not we are very competitive, looking at even some of our competitors who will go all the way to 5%. But for us, we feel the 2% that we are charging is quite competitive, and it gives you value in the end of the day for us to be able to manage these funds well and to the best of our knowledge, and also to make sure that we compliance with Capital Market Authority. So for sure, from where we sit, we don't think we are not very competitive in terms of the management fee. Back to Fiona.
Thank you. Thank you so much, Dominic, for that explanation. I think we are short on time, but I can see a lot of questions coming in. We'll be able to reach out to you and respond relevantly to the remaining questions that we've not been able to respond to. But again, is to thank you so much, our heroes. I think it was a very engaging session. We've asked questions. We've been able to get the responses on the same. And I'm sure I've been able to take a lot from this. We are looking to do many more of these webinars, and we'll be able to reach out to you in good time so that you're able to join us and be able to discuss and impact knowledge on what is happening in our economy and generally in the global environment. So thank you so much for the interactive session. At this point, I'll hand this over to Mwenda to give a vote of thanks and close the session for us. Mwenda.
Thank you, Fiona. A big thank you to our heroes for joining us today. I think it was a very productive session, given the kind of questions that you have asked. Ours is to invest in you. So we walk the journey together, even as you invest in our funds. We want to make sure that you're equipped to judge the level of investment you can make, to understand what is happening. So you actually also can understand what funds work best for you, to understand the level of risk you're taking, vis-a-vis the return that you're actually making. So to become a better investor, you become better informed. And we want to walk that journey with you, give you a lot more information, educate you, and provide value over and beyond just the return that we're providing you. We also want to make sure that we offer you a lot more. And even as we have discussions with the people out there, whether it's your friends or it's your colleagues, just let us know what more do you want us to teach you and guide you, so that even as you make your investment decisions, because these are not the only assets you're investing in, there's a lot more in terms of investment decisions you're making. There are a lot more in terms of personal decisions you're making. There's a lot more in terms of business decisions you're making. And all that comes down to the fact that you need to understand some of the items that are going on. There's a lot more that is happening in the world. Ours is to inform you, guide you, and walk your investment journey with you. Thank you very much for joining us, for sparing time to be with us. We are grateful for that time. And for sure, we'll work harder to make sure that we have a lot more of these sessions and have a more interactive sessions with you. And thank you very much for making the time. On behalf of Absa Asset Management Limited, we want to say a big thank you to our heroes, and may the Lord bless you. Thank you very much.